Hi everyone, welcome to part 2 and the conclusion of my analysis on Walgreens. We're going to wrap up the model today, and then we're going to look at some competitors, and then finally we're going to kind of form some of my investment thesis on this company. Um, so we ended at no PAT, net operating profit after tax, from part 1. And off screen, I filled in capex, depreciation, and then change in working capital, just to save time, so you don't have to watch me, spend 20 minutes typing numbers in. But I'll still show you where you can find that. So capex is found on the cash flow statement under additions to property, plant, and equipment. Okay, and then depreciation is found in the section above. I did want to make one correction. So last time I said that it looks like they had a really bad quarter in Q2 because their operating expense went way up. And after reading their cash flow statement a little more closely, I realized that that's actually not the case because there's this line item called goodwill and tangible impairment for $2 billion, and it's an add back to net income. So it's actually a non-cash event, just like depreciation. And then if you search impairment, you can find out a little bit more about what this is. It's in note 6, goodwill and tangible assets. So they said that because of COVID, they've made an accounting adjustment to the value of their assets for Boots and other international divisions. So they're saying that, because of COVID and uncertainty with COVID, we think that the businesses are not gonna, they're worth less now. But this is not a cash event, and we need to add that back, right? Because it's not like they actually incurred that $2 billion cash expense, and we're after free cash flow. Now maybe it does impact. They're saying it will impact the business value in the future, but the other side benefit of this impairment is that now, because their operating expenses are actually negative, operating income is actually negative, they have to pay taxes. They have a tax expense. This turned that tax expense into a tax benefit because of that impairment. So it's kind of a side bonus for them, if you can say it that way. So it looks like on an enterprise value to free cash flow basis, Walgreens trades at about 10 times free cash flow. So at the rate that they generate cash every year, if I invest in Walgreens, I can expect to basically make back my initial investment in about 10 years, and I still get to keep the company. So, I mean, intuitively, that's 10 times free cash flow is a very reasonable, very kind of attractive multiple, provided the company isn't, just dying and not going to be able to generate cash in the future. So we still need to fill in the return on invested capital. So let me do that right now. So again, we are looking for book equity, which is in the balance sheet. $27.36. And their debt, let's do another quarter. This is Q1. Debt is 5984 plus 1065. Equity 23,720. Equity 23,512. Debt is 5738 plus 11098. Okay, let's do one more quarter. Debt 6225 plus 628. Equity 23,661. $23,512. Wait, isn't that? Oh, okay. Got it. Yeah, they so here they've only, so this is something weird they do on the balance sheet. Instead of showing like the quarter prior, they just show instead of showing like the quarter the year before, they just show like their fiscal year end balance sheet, and that's why it looks kind of weird. So yeah, so then I have to $10Q, 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 $10K, $10Q again. Yeah, the more of these you do, the more you kind of get used to the quirks of these statements. Equity 24133. Debt. See, this is this is their fiscal year end of 2018, which is this quarter. And so let's look at their equity. That's 2607. Their debt was 1966 plus 12,431. Okay, we just got 2 more quarters to go before we can calculate their ROIC. Short-term debt 5356. Long-term debt 12685. Long-term, and then equity 24770. Finally, we've got 1 more quarter. Just on the next page. Short term 4344. Long term 11646. And equity 25609. All right, great. Okay, so their ROIC is around 10%. All right, so if you gave Walgreens $100, they're going to take that $100, turn it into $110 in a year. So one thing I'm curious about is kind of what's their cost of capital? How much does it cost them to borrow money? So to do that, can go to notes. Yeah, you can kind of see here. They're borrowing at about 2.8, 3%, 2%, right? So that's the cost of capital on debt. On equity, let's say 7%. So I would say their cost of capital is maybe around 5%, and then their ROIC is like 10%. So their ROIC minus their cost of capital, I will estimate to be around 5%, still a positive number. Certainly I'm just not looking, if it's a negative number, then we're in trouble, but still positive. So yeah, so I'm looking at their stats, and it looks pretty good. But one more check I want to do is I want to look at some of their competitors, because what if the industry is just like that? So I know one of their competitors is called Rite Aid. Another one is called CVS, and luckily they're both public companies, so we can take a quick look and do some analysis, some what's called competitive analysis. So let's pull up Rite Aid first. And another alternative to go on an SEC website is you can also go to the investor relations page of these companies, and a lot of times they're going to have the same information, and a lot of times they have something else called a press release that's pretty helpful. I'm trying to find that here. Might be called transcripts for them. No, it's not. All right, whatever. We'll just look up the 10K then, because I want, like kind of the 1 year picture for Rite Aid. For fiscal year ended February 29th, 2020. Yeah, fine. Let's see how many shares they have. 54,704. Okay. And let's look at what they're trading at. $13.35. Very low market cap, only 730 million. Let's see, balance sheet. This is why I don't like looking at the 10K. You gotta really dig through to find the financial statements, whereas it's usually the first thing in a 10Q. All right, I think we found it. All right, balance sheet. Cash, 218 of cash. Got any other stuff that's considered cash? Nope. Current assets held for sale. What is that? It's not cash. All right, let's see how much debt you have. Current maturities, long-term debt, and lease. Okay, so you got 8.8. Plus, 3077. That's massive. $3077. Operating leases don't count. So finance obligations, less financing obligation, lease financing. So finance leases do count, but it's not going to move the needle really. Finance leases is a debt. This is too complicated for this video. Wow. So, okay. So their equity is only Yeah, so this company, like their equity is only 20% and the rest of it is like debt. So they have a lot of debt. All right, let's see how much cash they generate. We'll just get like a rough idea from their cash flow statement. And okay, so they generated 510 of operating cash flow. Okay. What is all this stuff? 3 depreciation. But then remember, you gotta subtract out the equipment, right? So this is operating cash flow. This is what we did before, just a shorthand, because I just want to get an idea. I don't want to build a whole model. And then CapEx is 171. But here's what's interesting, like in 2019 they actually lost money, so it seems to be kind of inconsistent. In 2018 they made money, so it's not really that consistent, their cash generation. But anyways, all right, so 339 is how much cash they generated in that fiscal year. Enterprise value divided by free cash flow, 11 times. Yeah, you know, pretty similar to our guy Walgreens. Walgreens, remember, was like around 10 times. Although I will say Walgreens doesn't like have as much debt. They have a ton of debt. They have $3.3 billion of debt, and they generate 300 million of cash flow. That means it'll take them 10 years of their cash flow just to pay down their debt. I don't like companies with too much debt. But let's see, what else do they have? Principal payment on long-term debt. Change in... Yeah, so that's kind of a rough idea. And let's look at CVS. A little bit bigger company. First of all, what's their stock symbol? Ugh. So CVS is actually a little different than Walgreens and Rite Aid because they've done something called vertical integration. So they've actually integrated with the pharmacy, the PBM, the pharmacy benefit manager, which is kind of like the middleman between the insurance plans and the pharmacy and you. So they've like integrated down the supply chain. So they actually merged with, like, I think Aetna or something. Aetna, which is a health insurance provider. So I'm actually not sure if CVS is actually even a good comp anymore, but we'll still take a look. Let's just, because they do have a retail pharmacy just like Walgreens. All right, so first let's figure out how many shares they've got. Wait, basic average shares outstanding 1301. How much debt do they have? No short term. What about long term? 64,699. And how much cash? 5,683 plus their investment plus 2,373 plus long-term investment 1,7314. So that gives us, so CVS, I think because they merged with Aetna, is over 2 times the size of Walgreens. It's much bigger enterprise value company, much bigger company than Walgreens. And honestly, I just want to look at their pharmacy business, but I don't think they're going to split that out. So, all right, let's see how much cash they generate. Operating activities, here it is, 12,848. CapEx, purchase of property plant, 2,457. So after taking out CapEx, acquisition doesn't count. Yeah, they're also at 11 times, trading at 11 times their EV to free cash flow. So yeah, so originally I thought Walgreens was pretty cheap because it was trading at 10 times, but looks like their competitors are trading at just a little bit more than that. But Rite Aid has a lot of leverage, has a lot of debt, and CVS is they're combined with their pharmacy business, so it's not really a true competitor, but it's good to get an idea. So now it doesn't seem as undervalued as I thought it was after looking at their competitors, but still pretty attractive. One thing that's kind of interesting is you might be wondering why Walgreens has so little cash if they generate so much cash every year, right? Based on our analysis. And here's where I'll explain something about the cash flow statement. So you can kind of see what Walgreens, so we know that they generate positive operating cash flow. They don't spend all of it buying equipment. So then there's a section called the financing cash flow. So the financing cash flow is where the answer lies. So you can see that what they do with their cash, one, they repurchase their stock. Okay, so they do stock repurchases, and secondly, they also pay dividends. Okay, so it looks like what the cash they generate, Walgreens is returning that cash to shareholders. If you think about a company, once it generates cash, it has a few options, right? One, the company can just save the cash in a savings account, in an investing account, right? As a shareholder, you don't really want that. You want the company to use their cash to grow the business, to add value, right? They're not an investment manager. They're not professional money managers. So the second thing the company can do is they can go, hey, I don't have a good use of this cash. I'm going to return it to the people who own this business, and they're going to return it to shareholder. One way of doing that is they can pay what's called a dividend. Okay, that's like a quarterly, semi-annual payment. So if you own this stock, every quarter you're just going to get some cash from this company. It's called a dividend. It's almost like a interest or a coupon. However, it's not really guaranteed. It's not contractual. The company can always say, hey, we're going to cut our dividend. We're going to reduce our dividend. There's no hard obligation like a coupon. The other thing they can do is they can buy back their stock. And that's what Walgreens has done extensively. So they can say, hey, you own a little piece of the Walgreens, piece of the pie. I'm going to reduce that pie so you end up owning more of it. So they buy back their own stock. That's also another method of returning cash to shareholders. It's called buybacks. The third thing they can do is they can go out and acquire companies, and they can use that cash. They can buy, up and comers or competitors. In the past, Walgreens done that, right? They bought Boots, they bought other companies, but recently they haven't done a lot of big acquisitions. So it sounds like management thinks that, with the cash they generate, the best use of it is just to return it to shareholders in the form of dividends and stock buybacks, and that's fine. What I am interested in is what is the dividend rate, the dividend yield on Walgreens, and it looks like it's it's around 5%. It's quite high. They have a very high, what's called a high dividend payout ratio. So if you own Walgreens, the stock, it's also like you own the stock, but it pays you 5% in interest every year, right? Provided they don't change that. So, not considering if you save it in the savings account, you earn like 0 these days, or very low, like less than 1%. This is pretty good if you can stomach the volatility of Walgreens stock, right? So yeah, so let's think about some reasons why this could be a good investment. We talked about it. One, low EV to free cash flow. Is just trading at 10 times, right? Very low enterprise value free cash flow. It's like if you invest $100 now, every year it's gonna generate $10. Unless something goes really wrong with the business. What's another reason? Dividend yield. Yeah, so when they generate cash, they tend to return it to the investor in dividend or stock buybacks. Okay. And then let's think about some of the subjective reasons. So there's this kind of story going around that, like, it's actually quite an old story, that companies like e-commerce companies like Amazon, Walmart, Amazon will basically destroy brick and mortar retail businesses like Walgreens. And a couple things that you have to remember is, like, when I have a horrible migraine, or when I have allergies, I'm not gonna buy like over-the-counter medication from Amazon, because it'll take some time for that to get there, and it's stuff like that you need like instant. You need to get medicine like instantly, and I think that it's tough for Amazon to really replace that type of need, right? So I think that it probably fulfills a bit of it creates things that people find valuable. There's always a need for that kind of instant gratification when you have migraines and you need Advil and stuff like that, or you're out of toilet paper or something. So, or you're trying to fill your like I have this online pharmacy that my insurance uses, but like I really don't like it because it takes like a week for the medicine to get here. I'd rather just pick it up at Walgreens and it's ready like in a few hours, right? So there's some types of services where the speed, the expediency is key, and this is one of them. Like, does it have a moat? Nah, I mean, we already talked about it. They have competitors that kind of do the same thing as Walgreens, CVS, Rite Aid, right? Even Walmart pharmacy. So that's not really a good reason. So I'll just say, yeah, kind of a basic need. So let's think about some of the risk factors. One, doesn't trade at a significant discount to competitors. Yeah, we talked about this. 10 times versus like 11 times. Not a big discount. Although if you ask me would I own Rite Aid or Walgreens, I'd own Walgreens because it's got much less leverage, right? When you have leverage, when something goes wrong and you can't pay the interest on your debt, you're in trouble. Walgreens, a much bigger company. CVS, whole different animal. I'm not an expert in pharmacy insurance companies, like pharmacy benefit managers. So I think need to do a lot more education, kind of to understand how that business works. But yeah, they all kind of trade at similar multiples. So it's not like one has a huge edge over the other. ROIC is fine, I think. What's another risk factor or like a detractor? I do think, I don't know how liquid they are. They don't have much cash on hand. They have a lot of debt. I am curious, like, what is their debt schedule? And you can find that in their notes section. Okay, so I'm in the notes section. It looks like for their long-term debt, it's due 500 million is due 2030, so like 10 years from now. Not worried about that. Another billion is due 2050. Wow. 30 years from now. This one's due 6 years from now. So what I'm looking for is very recent maturities. So here's a recent one. Okay. $1.2 billion due next year in 2021. That's pretty recent. And then they got $1.2 billion due 2022. So as of right now, they don't have enough cash on hand to pay this debt, right? So they're going to have to do what's called refinance this debt. They're going to have to basically roll this over to a longer maturity. That I'm not super worried about because right now interest rates are so low and there's so much liquidity that a lot of companies are basically refinancing their debt. And Walgreens has really healthy cash flow, as we talked about. So companies or banks should have no issues refinancing and rolling over that debt, right? It's not like there's a big risk of Walgreens not being able to pay interest because the interest is so low. It's like the treasury rate is 0%, and their spread on top of that is maybe just a couple hundred basis points. So yeah, they don't have that many. They have a couple notes coming due, which is a little bit concerning, but then I'm not too concerned that they will be able to roll this over, refinance this debt. So, but we'll put that as a risk factor. Leverage. Trying to think what are some other risk factors. I talked about how in the US the pharmacy business, there's like a middleman called a PBM, and companies like CVS are like they're vertically integrating, right? They're not just the retail pharmacy, they also own the plan benefit managers. And Walgreens hasn't really done that, so maybe it's like long-term strategy could be a risk factor. Oh, another thing I forgot. I just heard that their CEO. So their CEO has recently stepped down, and usually when the CEO steps down, it's not. We have to find out why, right? So he says that. Why there's so many ad blockers? he's stepping down to become the executive chairman. And then they're finding a replacement for him. I think they're finding someone who's like ex Rite Aid or something. So yeah, I know that Stefano Pessina, this gentleman, he was like the founder and he owns a lot of Walgreens. I mean, one reason he might be stepping down is he's almost 80 years old. And then also the stock hasn't done anything. When the stock is stagnant or going down a lot, the management likes to shake stuff up. But I mean, ultimately, a lot of the stock market is optics, and I think it's a solid business. So I'm not too worried. It's not like he did something. He did something deplorable and he had to step down. Nothing like that. I think they just want to shake things up. I saw this happening with companies like Chipotle and stuff, where when the stock price isn't performing, the board likes to shake stuff up. But he's still remaining on as chairman, so it's not like he's completely out of the company. Still owns a ton of the company, so not. You can explore that a little bit more. CEO departure. Yeah, so let's summarize what we kind of compiled here. So Walgreens, attractive in terms of EV to free cash flow. Decent ROIC considering the line of business they're in. Great dividend. The company seems to be in the mode of giving back to their shareholders through dividend and stock buybacks. Okay. Not sure if it'll continue after COVID. And I think it's a pretty robust, or at least pretty sustainable business model, right? For the reason I mentioned earlier. Some of the risks kind of similar. Their competitors are not a leg above their competition. They're not generating a ton more cash relative to their value compared to competition. Has kind of quite a bit of debt that we have to watch out for the next couple of years. Doesn't seem to be keeping up with some of their competitors in the strategy of like vertically integrating. And then there's some shakeup in management. So these are, I'm just forming some of my like investment thesis and risk factors. Not sure if you agree with them or if you have your own, but so that's my kind of assessment of Walgreens. Overall, considering if you save your money in a bank account and I can save my money and earn like 0%, or invest in a Walgreens, earn 5%, but live with the volatility of a stock going up and down, but know that it's a fairly safe business. I think that's something interesting to think about. So, all right, I'm going to stop there. Thank you.